Euro to US dollar just kissed 1.1450. That's not a breakout, that's a bull trap. Weekly sellers are already positioned for a free fall. The dollar dipped on labor data, but Iran tensions are about to trigger a safe haven stampede. Hidden bearish divergence says the next leg down will be brutal. At 1.1432, the market has just printed a number that is about to destroy over-leveraged bulls. Watch this. There is one danger zone and one hidden opportunity right now. I'll show you both. The euro has crawled higher, yes, up 0.14%, but the weekly chart is screaming strong sell, and that's the only frame that matters. Most traders see a dollar dip and chase euro longs here. That's exactly the trap. A freefall trap. On your screen right now you see the words 1.1450 trap. 2 scalps plus 1 swing. Write that number down. Because if you understand the pivot at 1.1450, you're about to get 2 scalp plays you can execute in the next hour, and 1 swing short that captures the next multi-session drop. Stay to the end. I'm giving you the exact stops, the exact entries, and the one level that, if touched, vaporizes the entire bear case session bias. Fading the bounce. The intraday timeframes show a 5-hour and 1-hour buy signal, but that's just noise inside a weekly strong sell. The daily trend is neutral, but the structure is blatantly bearish. Price sits below every major moving average, the 20, the 50, the 100, the 200, and RSI at 43 is not oversold, it's weak. The ADX is at 38, confirming a trend, not chop. So the session plan is simple. We wait for price to stumble into the resistance coffin between 1.1439 and 1.1453, and we sell that failure. Single invalidation level that flips my bias, a 4-hour close above 1.1480. That's a 3. If the euro body's above 11480, then this whole structure resets, and I'll flip to a breakout chase. Write that number down, 1.1480. The herd is positioned long this tiny bounce, betting on more dollar weakness after stable labor numbers. And that's exactly why the liquidity is sitting above 1.1456, waiting to be grabbed. When the retail crowd is all leaning one way into a weekly trend that's screaming the opposite, the stop hunt is almost mathematical. Let's zoom out and walk the structure from the weekly all the way down to the 60-minute. The weekly chart is unapologetically strong sell. Lower highs, lower lows. The last meaningful rally died right at the 1.16 zone, and ever since, we've been stair-stepping lower. The weekly moving averages are all sloping down, and the MACD is deeply negative with no sign of a turn. That's the big money flow. Institutions are selling euros every time we get a bounce. Drop to the daily. Daily trend is neutral, but don't let that fool you. Neutral in a strong weekly downtrend means consolidation. Before the next leg. Price is currently at 1.1432, crawling underneath the 20-day moving average at 1.1453. The 50-day is way above at 1.1525, the 100 at 1.1584, the 200 at 1.1563. That's a classic bearish alignment, price below every smoothing line. The RSI at 43 is tucked under 50, confirming momentum to the downside. MACD is negative, minus 0.004, and the histogram bars are flat, which often precedes a volatility expansion. And that's exactly the setup, a compression that explodes into a trend day. Now the 4-hour chart. Here's where it gets deadly. We've been in a corrective channel since the last low near 1.1357. The current bounce has carried us into the pivot zone at 1.1415 and just above. But look at the moving averages on the 4-hour. The MA20 is at 1.1453, directly aligned with the daily MA20. That's confluence. The MA60 on the 4-hour is also sloping down, reinforcing resistance. Here's what most traders miss. There is a hidden bearish divergence brewing. On the 4-hour, price made a lower high around 1.1470 a few sessions ago, while the RSI actually pushed higher. Price makes a lower high, momentum makes a higher high. That's hidden bearish divergence, and it tells you the bounce is weak, the trend is exhausted on the upside, and the next move is a continuation sell. That's the signal the algorithms are watching. Combine that with a CCI of 73, which hasn't even hit overbought yet, meaning there's room for one more little fake-out push into the resistance zone before the rug pulls zoom further into the 60-minute and we see a short-term buy structure. Price popped above the hourly MA20 and MA60, which is why the scalpers are long right now. But that buy signal is running into the first resistance band, 1.1439, the R1 pivot. Above that, 1.1456, which is the R2 and the exact daily MA20. So the intraday battle is between the 1-hour buy and the daily or weekly sell. That's the clash. And that clash creates the scalping window. Our job is to trade the fake, key supports and resistances that matter. Resistance 1, 1.1439, currently being tested. Resistance 2, 1.1456, that's the bear kill zone. Resistance 3, 1.1480, the invalidation. Support, S1 at 1.1398, S2 at 1.1374, S3 at 1.1357. The daily ATR is 55 pips, so a move from the resistance zone to S2 is roughly 80 pips. Completely normal for this volatility regime. Cross-asset linkage is screaming caution. The dollar index is flirting with support, but watch the 10-year yield. If yields spike on geopolitical fear, the dollar gets a safe haven bid even if the Fed is on hold. That's the mechanism that crushes the euro. The next signal changes everything. If we see WTI crude spike above 90 on Hormuz shutdown fears, the dollar bid will crush euro to US dollar through 1.1398 like a hot knife through butter. Yesterday's news cycle handed us the perfect fundamental amplifier. The dollar initially dipped because US labor market data came in stable. No surprises, cooling some aggressive rate hike fears. Traders bought the euro on that relief. But within hours, the real story hit. U.S. Iran tensions flared. Reports of Hormuz Strait threats are escalating. That's the wild card. Historically, when the Strait of Hormuz is even whispered to be at risk, we see a stampede into the dollar, into treasuries, and a brutal sell-off in risk proxies like the euro. The analyst note today specifically warns that Hormuz tension tilts risks back to the downside for euro to US dollar. I completely agree. The initial dollar dip is a head fake. The geopolitical fear premium hasn't been priced in yet. Think about the policy divergence web. The ECB is talking about pausing. The Fed is still relatively hawkish. Yield spreads between German bonds and US treasuries are widening again in favor of the dollar. If oil spikes, that's an inflationary shock that forces the Fed to stay tighter while crushing European growth because Europe is a net energy importer. That's a double whammy for the euro. So the 1 to 2 week directional lean is firmly bearish. I'm looking for a move down to at least 1.1357, and if tensions escalate, 1.13 becomes the magnet. The exact event that invalidates this bearish lean is a daily close above 1.1525, the 50-day moving average, on a de-escalation headline. But I'm trading what's in front of me, not what I hope. Second interaction trigger. Do you think the dollar index breaks 105 this week? Comment yes or no right now. I'm tracking consensus across the channel. If you're seeing this and you think the dollar rips on Iran fear, drop a yes. If you think it fades, drop a no. I'll pin the best macro take. Most people skip this section. That's exactly where the money is made. Keep watching. I'm about to hand you 2 scalp strategies you can execute on the 15-minute and 5-minute charts today, and a swing short that holds for multiple sessions. These are not abstract ideas. These are exact levels with precise triggers and hard stops. Let's get into it. Strategy 1, the opening scalp, scalping, high probability. This is the fast snipe at the resistance zone. Here's the trigger. Price grinds up and touches 1.1445 to 1.1450. That's the sweet spot just inside a 1 and just before the MA20. On the 5-minute chart, you wait for a clear bearish rejection. I want a 5-minute candle that prints a bearish engulfing, a shooting star, or a strong pin bar. With the wick poking above 1.1450, and then the body closing below 1.1445. That's the entry trigger. You sell immediately on the close of that candle. Tight stop loss goes above the wick at 1.1465. That's a 15 to 20 pip stop, well within ATR. Take profit 1 is the daily pivot at 1.1415. That's about 30 pips from entry, giving you a risk reward of 1 to 1.5 minimum. If momentum accelerates, which it might on a headline, you can hold a portion for take profit 2 at S1, 1.1398. That stretches the R multiple to over 2. This scalp is instantly void if the 5-minute candle closes above 1.1460 with conviction. No wick, just body. That would signal the stop hunt is becoming a real breakout, and you step aside the opening SCALP entry, 1.1445 to 1.1450, 5M bearish engulfing after touch, stop loss, 1.1465 take profit 1, 1.1415 take profit 2, 1.1398 risk, reward, (1:2.0 R invalidation, void if 5M candle body closes above 1.1460 strategy 2, the liquidity grab, scalping, counter noise on 15-minute chart. This one is for traders who love hunting stop hunts. The setup exploits the fact that retail stops are clustered right above the overnight high at 1.1456, which is the R2 and daily MA20. Smart money often pushes price just above that level to trigger those stops and then reverses violently. Here's how you trade it. You watch the 15-minute chart. If price spikes above 1.1456, touches 1.1460 or 1.1462, and then immediately prints a 15-minute candle that closes back below 1.1450, that's the grab and snap back. You enter short on that close below 1.1450. Stop loss goes just above the wick, at 1.1470. The target is the nearest intraday liquidity pool, which is the pivot at 1.1415, identical to the first scalp target but faster execution. This is a quick in and out, a 1-to-1.5 scalpel trade. It requires fast fingers, but the pattern repeats. Warning: if the 15-minute close above 1.1456 is not rejected within 2 candles, the grab fails, and you cancel the idea. Don't fight a real breakout. The liquidity grab entry, short on 15M close back below 1.1450 after a wick to 1.1460, 1.1462 stop loss, 1.1470 take profit, 1.1415 risk, reward, (1:1.8 R invalidation, void if 15M stays above 1.1450 for more than 2 candles after the spike. Are you scalping or swinging this week? Comment the word scalp or swing right now. I want to see where this community sits. Because the swing players are about to hear the trade that sets up the whole week. Strategy 3, the session swing, trend alignment. This is the big one. The 4-hour and daily bias is a sell into resistance, and we are right at that zone. The trigger condition for the swing short is a 4-hour candle close below the 20-period moving average on the 4-hour, which currently sits at 1.1453, and ideally with the MACD printing a fresh bearish cross, signal line crossing below the trigger. That's your confirmation that the bounce is dead and the weekly trend is reasserting. If you see that close, you enter at market. Stop loss goes above the daily structure, placed at 1.1525, which is the 50-day moving average. That's a wide stop of about 70 pips, but that's the structural level that, if broken, says the bear trend is compromised. Position size accordingly. Take profit 1 is a conservative swing target at S3, 1.1357. That's roughly 80 pips from a 1.1453 entry, giving a 1-to-1.1 risk reward already. The stretch target, if the geopolitical bid explodes, is 1.1300, the next psychological magnet. Once price trades halfway to TP1, so around 1.1405, you move your stop to break even. That's the trailing rule. Invalidation for the swing is a daily close above 1.1525. That would shift the medium-term outlook to neutral, and I would scratch the bearish thesis. This swing plays out over 2 to 5 sessions. It's not a scalp, It's a hold through noise. The session SRNG entry 1.1453 for H close below 20 MA with bearish MACD cross, stop loss 1.1525 take profit 1, 1.1357 take profit 2, 1.1300 risk in reward 1:1.2R to TP1 1:2.2R to TP2 invalidation. Void if daily close above 1.1525 before I give you tomorrow's wildcard, a 30-second risk pulse. Never risk more than 1 to 2% of your account on any single trade. These scalps demand even tighter risk. A 15-pip stop on a 50-pip ATR pair means you need to size small. No positions through high-impact news like the Iran headline escalation or US ISM data. Stops are non-negotiable. Hard stops, not mental. If the market rips through 1.1480, you are out, period. This is how you survive to trade the next big move. The single most critical level for the next session is 1.1450. Period. Everything hinges on whether the euro gets rejected there or barrels through. Right now, the structure points to rejection, but we trade what happens, not what we hope. Tomorrow, I'm focusing on the US crude oil inventory report and any further Hormuz headlines. If we get a supply shock spike in oil, the dollar will rip and this euro freefall goes vertical. I'll have the updated blueprint exactly 24 hours from now, right here. If 1.1450 breaks and holds on a daily close, the whole monthly trend flips, and I'll be the first to map that breakout. If you want the full breakdown on trading commodities, Aussie dollar, Japanese yen, and Bitcoin, the videos are live now. Tap the end screen card to loop straight into the gold fear architect video. Then come right back to the S&P 500 gamma breakdown. Hit the bell now so tomorrow's alert lands before the European Open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter before the herd even wakes up.